Welcome to the deep dive. Today, we're really digging into Bitcoin investing, specifically how these ETFs and other, financial tools have kind of changed the game.
Yeah.
Bitcoin's not just for the tech nerds anymore, right? It's like front page news.
Exactly. With Wall Street giving the nod via ETFs and big institutions stepping in, it's a different world.
So the big question we're hearing, and probably you're asking, is, should I jump into Bitcoin? And if I do, how should I even approach it?
Absolutely. That landscape shift, particularly with the spot Bitcoin ETFs getting the green light, well, it's opened the door wide for folks who maybe weren't comfortable messing with crypto directly before.
Right.
So we've looked at a bunch of articles on these ETFs, the derivatives, the whole shebang, really, to figure out what it all means for you.
Yeah, our mission here is to unpack all that. We want to get a clear picture of the potential rewards, sure, but also the unavoidable risks, and figure out how you might think about investing. So whether you're already investing and just curious about crypto, or maybe you're totally new to Bitcoin and just trying to get your head around it, hopefully this helps.
Okay, let's dive right in. That first big question. Should you even think about putting money into Bitcoin?
Yeah, the $1 million or maybe $100,000 question these days.
Well, it's really important to be clear up front. Even with all this new acceptance, Bitcoin is still speculative. Very speculative, meaning its price can go wild, up, down, sideways, really unpredictably. It's driven by, well, a whole mix of things: the big economic picture, how many people are actually using the network, institutional interest. Yeah, and let's be honest, a fair bit of hype too.
Okay, but the narrative is changing a bit, isn't it? It's not just like monopoly money anymore.
That's true. There's this growing idea of it being like digital gold, a store of value, maybe even a hedge against inflation or governments predict too much money.
That potential hedge, right.
That shift in how people see it is definitely significant.
Sure.
But you still need some clear rules for who should really consider it.
Okay, so who fits the bill?
Generally, it's people with a high tolerance for risk. You got to be okay with potentially big losses. Also, people who genuinely believe in the long-term idea of decentralized assets, and maybe those looking for something that doesn't just follow the stock market up and down for diversification.
Right, adds a different flavor to the portfolio.
Exactly.
And who should maybe pump the brakes or just watch from the sidelines for now?
Well, if you're getting close to retirement, or if you might need that cash in the short term, Bitcoin's wild swings probably aren't your friend.
Not ideal for stability.
Definitely not. And if those big market drops would make you lose sleep, or, and this is super important, if you don't actually understand what it is you're buying, maybe hold off.
Do your homework first.
Seriously.
Yeah.
Research isn't just like a good idea. It's absolutely essential before you put a single dollar in.
Okay, makes sense. So let's say someone listens to all that, does their research, and decides, okay, maybe Bitcoin has a place for me. What's the next step? How much?
Yeah, how much to actually allocate, that's critical. The standard advice you'll hear from most financial advisors is keep it small, especially for something high risk, high potential reward, like Bitcoin.
Like a rule of thumb.
Yeah, the common one is maybe 1% to 5% of your total investment portfolio. No more than that.
1 to 5%. Okay. Can we break that down a bit? Like, what does 1% look like versus 5%?
Sure. So 1% would be pretty conservative. If you're balanced, maybe 2% to 3%.
Okay.
If you're more aggressive, really comfortable with the volatility, maybe you push towards 5%, perhaps a little more.
And beyond that?
Anything much higher, like 10% or more, advisors usually start calling that, well, highly speculative, or even a bit degenerate, though we wouldn't recommend that. It's just putting a lot of eggs in a very volatile basket.
Got it. Keep it a small slice. But even at, say, 1%, can it actually make a difference given how much Bitcoin has moved historically?
Oh, absolutely. Because of Bitcoin's historical performance, which is no guarantee of the future, of course, but even a tiny 1% allocation could have an outsized impact over the long run. The key is really just start small. Know you could lose it all. Don't bet the farm.
Right, right. So we've talked should you and how much. Now, the how. How do you actually invest? It feels like there are way more options now than just figuring out crypto wallets and seed phrases.
Oh, totally. That's been a huge evolution. You don't have to deal with all that technical stuff anymore if you don't want to. We've got these different financial instruments now, like ETFs and derivatives.
Okay, let's start with the one getting all the headlines. Spot Bitcoin ETFs. What are they exactly?
So think of them like a regular fund, but instead of stocks or bonds, they actually buy and hold real Bitcoin.
So you own shares in the fund, and the fund owns the Bitcoin.
Precisely. It lets you get exposure to Bitcoin's price movements without you having to buy it, store it safely, manage keys, any of that.
That ease of access, that seems like the really big deal here.
It is. It potentially brings in a whole wave of investors and capital from the traditional finance world who just wouldn't touch direct crypto before.
Yeah.
That could really impact the price and, long-term adoption.
And there are quite a few of these now, right? Which ones are people talking about?
Yeah, the big ones you hear about are BlackRock's iShares Bitcoin Trust, that's IBIT, Fidelity's Wise Origin Bitcoin Fund at BTC, ARK 21 shares, AKB.
Okay.
Then there's Grayscale's GBTC, which actually converted from an older trust structure, plus Bitwise, VanEck, HODL is another one.
Lots of choices. Are the fees competitive?
Yeah, they've been coming down. HODL, for instance, is at 0.20%, but waived for a while. IBIT is around 0.25%, so pretty low compared to older crypto funds.
Okay, so what are the main pros of using these spot ETFs? Why go this route?
Well, first, they're regulated. The Bitcoin is held by big trusted custodians. You mentioned Coinbase holding a lot, like 85% of the ETF Bitcoin. Fidelity custodies their own too. That's a big security plus versus holding it yourself on an exchange.
Reduces that hack risk worry.
Exactly. Second, they're super easy to buy and sell. Just use your normal brokerage account, like buying a stock. No crypto exchanges, no private keys to lose.
Simple.
And third, you can often hold them in tax-advantaged accounts, like IRAs in the U.S. That can be a really big benefit for long-term savings.
Sounds pretty appealing. Any downsides? What should people watch out for?
Yeah, there are a few things. You do pay those management fees. Even if they're low, they still eat into returns over time, 0.20% to maybe close to 1% annually, depending on the fund.
Okay.
Also, you get the price exposure, but you don't own the Bitcoin. So you can't send it to someone or use it in DeFi or anything like that.
You're just tracking the price.
Right. And while they track the spot price, the current market price, the ETF share price itself, can wobble a bit based on its own supply and demand. Usually it's very close, but it's not always perfect second-to-second tracking.
And they only trade when the stock market's open, unlike Bitcoin itself.
Good point. Yeah, Bitcoin trades 24/7, but the ETFs are stuck to market hours.
So who are these spot ETFs really best for?
I'd say passive investors, mostly. People who want Bitcoin exposure but want it simple, regulated, maybe in their retirement account. Great entry point for crypto newcomers, too.
All right, now what about those other Bitcoin ETFs, the futures-based ones? How are they different?
Right, those came out first, actually. Instead of holding Bitcoin, they hold Bitcoin futures contracts.
Futures contracts, like agreements to buy or sell Bitcoin later.
Exactly. Usually traded on regulated exchanges like the CME, the Chicago Mercantile Exchange.
And we know some of those names too, right? BITO.
Yeah, ProShares BITO is the big one. There's also VanEck's XBTF, Valkyrie's BTF. But one thing to note is their fees are generally higher. BATO, for example, is close to 1%, like 0.95%.
Ouch, higher fees.
Yeah.
So what was the appeal? Why did they get approved first?
Well, the main thing was regulatory comfort initially. The SEC was okay with futures contracts before they were okay with spot Bitcoin directly.
Ah.
And they're easy to trade on regular platforms, too. Plus, futures have inherent leverage, so maybe some potential for amplified moves, though that cuts both ways.
But we hear a lot about problems with these futures ETFs. What are the big drawbacks?
Yeah, the main one is this thing called contango risk. It's a bit technical, but basically futures contracts for later delivery often cost more than the current spot price.
Okay.
So the fund has to constantly sell the expiring contract and buy the next, more expensive one. It's like a constant small headwind.
It just bleeds value over time.
You can, yeah. Some estimates put that contango drag at potentially up to 10% a year in bad conditions. So partly because of that and the higher fees, these futures ETFs often underperform actual Bitcoin.
So less efficient for holding long term.
Definitely less efficient than spot ETFs for long-term holds. Plus, they're still volatile, and the whole futures rollover process adds complexity. And there's basis risk, too. The futures price might not perfectly track the spot price.
So who would even use these now that spot ETFs are here?
Mostly sophisticated traders, maybe, looking for short-term tactical plays, perhaps if spot wasn't available for some reason. But yeah, for long-term investing, the spot ETFs have really taken over.
Okay, let's get into the spicier stuff. Leveraged and inverse ETFs. What's the deal there?
Yeah, these use derivatives like futures or swaps to try and give you, say, double the daily return of Bitcoin, or maybe the inverse return if you think the price is going down.
Double the daily return. Wow. So BITX is an example.
Right. Volatility shares, 2x, Bitcoin strategy, EPF, BITX, that's one.
What's the attraction? Big gains fast.
That's the lure, yeah. Huge potential returns if you guess the direction right very quickly.
But I'm sensing a but coming.
Oh, a massive but. These are extremely risky. They reset daily.
What does that mean, reset daily?
It means the compounding gets weird. Over time, their performance can drift wildly from just, say, 2x the overall move of Bitcoin. You can actually lose money, even if Bitcoin generally goes up, if it's a choppy ride day to day.
Seriously?
Yeah, it's called volatility decay or return decay. They're absolutely not meant for holding long term, strictly for very short-term speculation by people who really know what they're doing
Yeah.
and can afford to lose big.
Like surfing a tsunami, maybe?
Yeah, something like that. Thrilling if you nail it. Total wipeout otherwise.
Got it. Okay, shifting slightly. What about just buying stocks of companies involved with Bitcoin? Indirect exposure.
Right, another way in. We're talking about companies that either hold a lot of Bitcoin on their books, like MicroStrategy,
MSTR, yeah.
or crypto exchanges like Coinbase, Coin9, or even Bitcoin miners. There are ETFs for those too, like WGMI or DAM.
What are the pros of doing that?
Well, they trade like regular stocks, so easy access again. And maybe the company has its own business growth potential besides just the Bitcoin price going up.
Makes sense. And the downsides.
Well, their stock price won't perfectly track Bitcoin. Sometimes it'll do better, sometimes worse. Plus, you have all the normal stock risks, company execution, competition, dilution, market sentiment towards that sector. Mining stocks especially are sensitive to energy costs and Bitcoin's mining difficulty.
So it's a correlated but different bet.
Exactly. A hybrid bet, maybe, on crypto and the tech sector around it.
Interesting. Now, beyond ETFs and stocks, you mentioned other derivatives. Sounds complicated. Give us a quick tour.
Sure. It gets pretty complex quickly. We're seeing options now on some of the spot ETFs like FBTC and GBTC since late 2024.
So you can bet on the ETF price itself.
Right. Then you have things like CFDs, contracts for difference ETNs, which are like debt notes tied to Bitcoin's price, perpetual swaps popular on crypto exchanges, even really niche stuff like hash price NDFs for miners to hedge their revenue.
Whoa. Okay, what's the main takeaway on these more exotic derivatives?
They're mainly for sophisticated traders. For speculation, hedging complex positions, maybe trying to generate any key selling options. But the complexity goes way up, and so do the risks.
Like what kind of risks?
Things like time decay on options, they lose value as they near expiration. Extreme sensitivity to volatility. Sometimes poor liquidity, meaning it's hard to get in or out at a good price. And definitely counterparty risk. Are you sure the other side of your bet can pay up? Plus, many involve leverage, which we know amplifies everything.
Okay, so lots of ways in, but lots of specific risks. Are there some big picture risks that apply no matter how you invest in Bitcoin, even with a safer spot ETF?
Oh, absolutely. The underlying asset is still Bitcoin, right? So you can't escape some fundamental risks.
Hit us with the big ones.
Number one, still, is volatility. We just have to keep saying it. Bitcoin can and does have massive price swings. Like 20, 30% drops in weeks, 20% in a single week isn't crazy. 50% drawdowns have happened, and ETF smooth the access, not the price swings.
Got it. Volatility is baked in. What else?
Regulation. It's still a patchwork globally. Even with the U.S. spot ETF approvals, there isn't comprehensive crypto law yet. A sudden crackdown somewhere or unexpected new rules could really shake the market fast.
Right, the regulatory uncertainty remains. What about security, custody? You said ETFs help, but are they totally bulletproof?
They definitely help the investor avoid self-custody risks. But the ETFs themselves rely on custodians like Coinbase. Are they 100% immune to massive hacks or mismanagement? Probably not 100%. The risk is lower with big institutions, but it's not zero. And having so much Bitcoin concentrated with one or two custodians is its own kind of concentration risk.
Good point. Any other market risks?
Well, market manipulation is still a concern. It's a global, less regulated market than stocks. Also, liquidity events, think flash crashes. Sudden sell-offs can cascade, especially with leverage in the system. Newer ETFs might have wider bid-ask spreads sometimes, and derivatives can definitely face liquidity crunches.
And tracking error.
Yeah, especially for futures ETFs with contango, like we discussed. But even spot ETFs can have small deviations from the net asset value, just due to ETF trading dynamics. And don't forget counterparty risk for anything involving derivatives or ETNs.
Okay, wow. That's a lot to consider. So let's try to pull this all together. What are the key takeaways if someone's thinking about using these newer, easier ways to get into Bitcoin?
I think the main thing is, for most people, curious about Bitcoin, but maybe intimidated by the crypto exchanges and wallets, these spot Bitcoin ETFs. They're probably the simplest, most straightforward, and relatively safer on-ramp right now.
Solves the custody headache, integrates with existing accounts.
Exactly. But, and it's a big but, you have to balance that ease of access with the fundamental nature of Bitcoin itself.
Meaning the risk is still there?
Precisely. The ETF wrapper makes it easier to buy. It doesn't make Bitcoin less risky inherently. Treat it as a bold bet, a high-risk part of your portfolio, not a safe haven.
So final advice for someone taking the plunge.
Start small. Seriously, only invest what you could truly afford to lose without changing your life. Stay informed, watch regulatory news, see what institutions are doing, and invest with conviction based on your research, but not, blind faith or hype.
And things have been pretty wild recently in the market, right? What's the snapshot look like now, early 2025?
Yeah, it's been quite a ride. Bitcoin blew past $100,000 earlier this year. A lot of that seemed fueled by the ETF launches bringing in institutional money, plus maybe a feeling of more regulatory clarity or at least acceptance.
Those ETF flows were huge, weren't they?
Massive. IBIT hit $50 billion in assets under management in just like 50 days. That's incredibly fast. Total net inflows across all the spot ETFs were something like $57 billion by the end of 2024, and huge trading volumes off exchange too, suggesting big players are active.
But the volatility warning still stands.
Oh yeah, even with that surge, analysts are still saying, hey, watch out for 20% pullbacks. That's just normal for Bitcoin. So the outlook seems kind of positive, especially if regulation stays favorable, but nobody should be surprised by sharp corrections, especially if the wider economy gets shaky.
Really crucial context. Thanks for laying it all out so clearly.
Happy to do it.
Okay, that pretty much wraps up our deep dive on Bitcoin ETFs and derivatives.
But before we sign off, maybe one last thing for you to think about. All this easy access through traditional finance ETFs, options, everything integrated into brokerage accounts. How might that change Bitcoin itself in the long run? Does it change its original purpose, that decentralized idea, when it gets so tied up with Wall Street?
That's a deep one. Definitely something to ponder. And as always, folks, please think hard about your own risk tolerance, do your own research. This conversation is just a starting point, right?
Absolutely. And maybe ask yourself, what part of this evolving story, what development or what risk really jumps out at you the most? What feels most significant?
Good question to reflect on. And hey, keep an eye on those practical things too, like the fees on these ETFs. We mentioned BlackRock and Fidelity are already cutting costs to compete. That stuff matters for your bottom line.
For sure.
All right, thanks everyone for joining us for this deep dive.